Hello there. Today is Tuesday, April 14th, 2026, and welcome to the Kluge Wealth Advisory Group Client Connect video. This video will be a bit brief. We're going to touch on a few observations as well as on a couple of frequently asked questions that we've seen come up in recent client conversations. So let's just jump right into it here. Let's jump into some observations here. Now, the first and number one observation I always want to bring up is that the situation is fluid. Things are changing and surprises are happening. We're 6 weeks into this conflict and a lot of things have happened that no one would have predicted so far. So bearing that in mind, one of the things I did want to observe is that there's a very, very high level of fear amongst market participants and investors in general. I think a lot of them are really feeling like our deer in the headlights, or for any of you who have kids or grandkids who have watched Ice Age, the squirrel in the headlights, as you'll see up on the corner there. So I think that does sum up a lot of the feelings that investors have, and that is significant, and that's something we're going to talk about a little bit more later. The next thing I want to talk about is that in a long-term perspective, having a number of corrections over the course of the year is perfectly normal. It's very normal that the S&P 500, again using US data but still relevant here, has a number of 5% and 1 10% correction per year. So you can see from this chart here is that these type of movements that we've seen where we had a 10% correction from top to bottom already is completely normal, and even though things may feel disjointed, nothing here has happened that is unusual at all. Now, I always want to also remember that no one rings the bell at the bottom, and that markets always bottom on bad news. And so with the fact is that the conflict is ongoing and we've seen markets rally back up to near highs as of today, that is completely normal and expected. The market is seeing through the end of the conflict and as I have said previously, they're looking at the fact is that everyone is talking past the sale. We're figuring out what the shape of the peace is, not the shape of the war. Now, again, there's a lot of dire predictions that I've seen out there, about potential massive spikes in inflation, the fact that this is could spiral out of control, etc. And all those concerns do have a grain of truth in them. However, when it comes to these situations, especially when we're dealing with the fog of war, it is very important that we remember the law of slow-moving disasters, which says that if a disaster is foreseeable and we can see that we're moving towards it, that we will likely do something, to mitigate it or to stop it. And to me, this type of law of slow-moving disasters makes sense because that's exactly how we survived evolution, right? I mean, we saw that we might need food for the winter, we went out and got it, and then we had food for the winter. Not having food for the winter, of course, would be a disaster. So again, when it comes to these situations, no matter how dire the headlines, always remind yourself of the law of slow-moving disasters. So over the course of our client conversations over the last couple of weeks, there was one key question that we saw come up over and over again, and that is the question that says, obviously we've seen a lot happen here. Markets are holding up really, really well. Why? And I think that's a really great question because even as we're sitting here videoing today on Tuesday, April 14th, I will tell you that portfolios are up year to date. Like, we have no model that's down. They're all positive and starting to make some actually reasonable headway for the year. Now, I think one of the key things that makes this surprising to a lot of folks is that when I observe a lot of financial media or a lot of observation about the market or what's being written, there's an embedded assumption in a lot of reporting, and that embedded assumption is that oil price spikes cause market and economic crashes. And I'm just going to say is that may happen in this instance. However, if we take a look back at financial history, see that so far this just hasn't been true. If we take a look at the graphic that we're going to put up here, there's been 224 recorded instances of an oil price spike, that we can bring up in modern history, and we can see very clearly that even in the short term, but especially in the intermediate term, markets respond positively. And that means that assumption about oil price spikes equals market crash is a faulty one. Now, there's a number of other reasons why markets can also be up, and be positive despite all of the negative headlines that we've been seeing. Now, the first one I think that's the most important is the fact is that earnings estimates have gone up since the Iran war began. Now, this is very significant because if you have a jump in earnings expectations, that makes the market cheaper. And then if you have the market pull back a little bit, it becomes even cheaper. So we've got a situation where we've had, with a very minor correction, a full valuation reset. Now, a full valuation reset. If we were in a world where earnings estimates hadn't gone up, yes, it is very likely the stock market would have gone down 20% to get that same reset. So the fact that it occurred on such a mild pullback because of earnings going up is one of the reasons things have held up. Now, why would that earnings reset be there? And I think that that earnings growth estimate is really tied to the fact is that we see continued economic growth and continued acceleration in real-world economic measures. Now we can see from key survey data that looks at the industrial economy in the U.S., which has been in a tough spot really for the last 30 months. It's very clear now that there's a positive trend in the industrial economy in the U.S. And if we look at real-world measures of economic activity, such as truck traffic and rail loadings, we can see that they are going up very, very steadily. So all those are very positive, and definitely you do not see truck traffic going up or rail loadings increasing in a recession. It only happens in an expansion. So we can be pretty confident that the world's largest economy, the engine of the world economy, continues to grow. The next thing we always want to remember here is that the stock market is also partly an expectations game. And that when investors get too negative on the outlook, that generally leads to a very positive response. And when investors get too positive on the outlook, it leads to a negative response. Again, we always want to be living in alignment with Warren Buffett's saying that you want to be greedy when others are fearful and fearful when others are greedy. And we can definitely see, through this data, courtesy of Ned Davis here, that investors are fearful. And they've gotten so unusually fearful, in fact, that forward returns look really, really good. In fact, based on this Ned Davis data, we should expect returns of over 20% in the next 12 months. Now, I'm not saying that's going to be true. That's not a prediction. But again, the historical pattern is clear. Investors' fear is high. Future returns are also high. And this also brings me to another important tailwind for why markets have held up. We're in a situation overall where markets have typically done very, very well. If we take a look, and this is where I always love to draw on quantitative studies that look at history. And if we look at key quantitative studies and indicators such as the turn of year barometer or the January barometer, they both point in the same direction. And they both say that 2026 should be a positive year about 90% of the time, and the market should be up in the mid-teens to the low 20s. Now that's certainly not a guarantee, and it's certainly not a prediction on my part, but what it's saying is that based on these indicators and other ones that also back them up, that the preconditions are there for that type of a result. So if it happens, we shouldn't be surprised. We should be surprised if it doesn't happen, and we always want to be aware that it could, but we shouldn't be surprised that if you have a positive setup, that positive things happen. So hopefully that provides some clarity on this point. And if you do want to get into this in more detail or talk a bit more about it, please reach out, book a time on Calendly, email us, be in touch any way you want, and we're happy to have that conversation. Another frequently asked question that we've been seeing quite a bit of here is the question that says, well, what have you been doing to take advantage of the situation? And the answer to that is very simple. But the first thing that we've done is we ensured that back in January we were prepared. In January, our risk management systems indicated that we should take a little bit of caution, and we did. And so we raised some cash to ensure that there was dry powder in the portfolio and that we were allocated to some defensive sectors that may benefit from volatility. Now, as volatility began to pick up through late February and into March, we did a number of things. Number one is we reduced the amount of cash that we had in the portfolio. We used it to buy international stocks, which were more impacted by the rise in oil prices than North American shares. The second thing we did is we reallocated from defensive sectors such as consumer staples into sectors that will benefit when air quotes the fog clears. And the key sector in this case would be the energy sector and the US financial sector. So in those instances, selling defensive sectors such as consumer staples to buy technology and financials is another thing that we have done. And we can see that as the markets recovered, there's been quite a springboard effect. If anyone takes a look at their portfolio balance from March 31st and compares it to today, Tuesday, April 14th, they'll notice quite a remarkable change in 2 weeks. And a lot of it has to do with markets recovering, but also the slingshot effect of putting money to work in depressed assets when fear is high. So, of course, if you want to talk about this further, or you want to go into a little bit more depth on our strategy and how it works for you, please pick up the phone, send us an email, book us on Calendly. We're happy to have a conversation, let you know exactly how things are working working here for you.